Today, the immutable force of gravity. Hello, it's Martin North from Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 30th of March 2019, our weekly digest of the latest finance and property news with a distinctively Australian flavour. Well, this last week has continued the grind of poor news, with more economic data confirming the local slowdown, the inversion of the 10-year to 3-month yield curve in the US, which signals a potential recession ahead, and more data relating to households and their finances, which also continues to show that they have significant issues in hand. And just before we get started, a quick reminder that you can make a one-off donation via PayPal to help us with our research and analysis and these posts, or contribute via Patreon on a monthly basis, where you can also get access to additional research and other information. Here are the links, and they're also in the comments below. So we're going to start with the old favourite, which is the auction clearance statistics. So the overall weekly clearance rates remains relatively constrained. There's been a slight bounce at this time of year, there often is, but the overall levels are still relatively low on very low volumes. The final data from CoreLogic last week showed that across the main centres, the weighted average of clearances were at 50.9%, which in fact was lower than the previous week. And whilst the ratings were a little higher in Melbourne, the volumes continue to languish compared with, say, a year ago. So there is really little evidence here of anything other than continued slowing across the housing sector. In Sydney, the clearance rate was at 52.1%, in Melbourne at 55.1%, in Brisbane at 28.2%, in Adelaide at 46.3%, in Perth at 40%, and in Canberra at 48.3%. And just to re-emphasise once again, this is considerably lower than a year ago when already clearance rates were falling. So here are the CoreLogic home price indices to the 28th of March. And we can see that there have been considerable falls in Sydney. The from peak is now 13.9%. In Melbourne, the from peak is now 10.3%. In Brisbane, not looking quite so bad, with the fall from peak down 1.3%. In Adelaide, there's almost no change over the year, but in Perth, we see an 18.3% fall from peak. And in the major 5 centres, the overall number is down 9.8%. Now, of course, just to reiterate, this is once again an average, and there are home price movements higher and lower in every centre. But it does give us a sense of the continuing grind down in terms of home price values. And as a result of this, we know that more households are beginning to move into negative equity. Now we got the February data from both APRA and from the RBA relating to credit aggregates, and the credit impulse continues to slide. And in addition, we see the non-banks continuing to accumulate relatively market share. We made a longer post on this yesterday where we went into much more detail. But I think the message is pretty clear that the credit impulse, which is the rate of change of credit availability relative to GDP, continues to slow. And that will translate into lower house prices later. Now, there was an interesting post by Christopher Joy, and he spoke specifically about the mortgage-backed security sector and highlighted the fact that there were risks emerging as home prices fall. And his article included the chart from the Reserve Bank, which showed that the bank's non-performing housing loans are continuing to rise. And that's consistent with other data that we've seen from the various ratings agencies. And Chris also highlighted the fact that in the current environment, the number of households paying ahead or making prepayments is also going down, and that is again another indicator of stress within household budgets and the finance sector. Now, there was an interesting comment from a Hong Kong-based banker who actually said that the Royal Commission in Australia had done a reasonably good job of shining the spotlight on poor behaviour, which is actually quite widespread across banking internationally. Nick Pollard, who has held a number of senior banking roles, including the managing director of exclusive British bank Coutts and the CEO of Coutts Asia, said that while the major banks in Australia had shown a clear interest to be rid of their troubled wealth businesses, the fact remains that people need wealth management and financial advice. The challenge for Australia, which is the challenge the rest of the world has, he said, is how do you ensure the demands of customers are able to be met by organisations that can provide that advice in a fair and transparent way. The industry as a whole has not been very good at that over the last few years, and that's why regulators have become involved and it has become tougher to operate in this climate. And ASIC came out this week with a report looking at how consumers confuse general and personal advice, which gives them greater exposure to the risks around poor financial decisions. The ASIC report, called Financial Advice Mind the Gap, showed new independent research on consumer awareness and understanding of general and personal financial advice, and there were significant gaps. And the research showed that only 53% correctly identified that they were being given general advice, and only 19% correctly identified that they were being given personal financial advice. Now, there's a very, very significant difference between general and personal advice, because general advice is essentially not tailored to that individual at all and relates to just general thoughts about what people might do. Whereas personal advice is something which should be tailored to individuals' circumstances. And what that means is that people are unclear as to whether they are getting advice of a general nature or whether it is applicable specifically to them. And this shows that the financial advice reforms that flowed over the last 2 or 3 years have still not really hit home, and there is still a lack of clarity amongst consumers around getting financial advice. Now, one of our posts this week also discussed the recent evidence from the House Economics Committee when the new CEO at NAB spoke specifically about mortgage loan approvals. And interestingly, and as we discussed in our separate post in more detail, he said that the volume of loans may be down, and there were a number of reasons for that, but the proportion approved has not really changed, despite the fact that now a considerably larger number of issues need to be disclosed through the application process, specifically relating to costs. And of course, this week we also ran the live show with Harry Dent, and that's still available on demand. Here's the link. Harry, of course, discussed his thesis around the big cycles that are driving the financial markets, and he's still predicting a significant fall ahead. But ahead of that, he also thinks that the stock markets will probably run up first before they ultimately crash. Now, whether you agree or disagree with Harry, he's always good value, and I think the show was quite well received. Now, of course, Labour has confirmed that if they get into office after the election, they are going to implement the negative gearing reforms as at 1 January next year, which was ahead of time, I think. And that has created a certain amount of consternation, specifically among developers and the Conservative government, who both claims that it will lead to massive falls in home prices. Now, my own modelling does not bear that out. Remember that Labour's negative gearing reforms will only impact new existing property purchases. It will still be available for newly constructed property. So in fact, it may be a boost to new construction, all else being equal. The capital gains changes will also have an impact, of course. But if home prices do continue to slide, in fact, that will put a little less pressure on the rental sector because more people who are renting may consider purchasing down the track. So the modelling that is suggesting massive crashes in terms of home prices and massive rises in rentals, in my view, are completely misplaced. Now, the ABS published some interesting research this week relating specifically to household wealth and income. And they said that the household net worth decreased 2.1% in the December quarter. And that was driven by real holding losses on land and dwellings and financial assets. And in fact, that fall in household wealth is the largest since the September quarter 2011 in percentage terms and follows a 0.1% revised decrease in the previous quarter. Household wealth per capita decreased $10,198 to an average $404,319. And that followed a $2,263 fall in household wealth in the previous quarter. And this is the first consecutive decrease in household wealth per capita since December 2011. Now, the losses on land and dwellings amounted to $170.8 billion, and that marks the fourth consecutive quarter of losses and reflects the falling residential property prices over the past year. Real holding losses in financial assets were $141.2 billion, and the losses were mainly on reserves of pension funds, superannuation, of course, reflecting the falls in the Australian stock market during the quarter. Now, this chart shows the movements in land and dwellings and financial assets since December 1996. Now, this next chart shows the relative distribution of assets, and it clearly shows the falls in the real estate asset categories. And I think we can observe it's quite likely that we will see more falls ahead. Now, the household debt to asset ratio is at its highest in 4 years. The debt to asset ratios gives an indication of the extent to which the overall household balance sheet is geared. Household debt equaled 19.3% of assets. That's an increase from 18.9% over the previous quarter. And this is the highest ratio we've seen since December 2014. The mortgage debt to residential land and dwellings ratio rose to 28.3%, up from 27.5% in the previous quarter, indicating mortgage debt grew faster than the value of residential real estate owned by households. And the rise reflects falling residential property prices rather than strong growth in mortgage debt, although debt did continue to rise. And this is the fourth consecutive increase in the ratio and is the highest it's been since September 2014. And the final chart shows the gross disposable income of households. The household gross disposable income fell 2.6% to $312.7 billion from $321 billion in the previous quarter. When other changes in real net worth, commonly known as the wealth effect, is added to household gross disposable income, household gross disposable income adjusted for other changes in real net worth fell from $182.1 billion to $15.8 billion. And this was largely driven by real holding losses in land and dwellings and financial assets. So this once again underscores the criticality of property and its relationship to household wealth. And the negative wealth effect is certainly apparent. Now, of course, we had the vacancy data out this week, and it showed that the number of job vacancies is easing. And yet ANZ said that they expect no change to RBA policy as the labour market remains strong. The tone, they say, will likely remain cautious. However, owing to risks associated with housing, credit conditions and labour market expectation, risks, though they say, remain balanced, as strong unemployment data has been offset by the weaker fourth quarter GDP and other soft leading indicators. And they said the government will be tempted to find vote-winning measures ahead of the coming election, given receipts are growing more strongly than expected, and so the RBA is likely to welcome income tax cuts, preferring this stimulus over a lower cash rate, which would not address household credit supply constraints. So it seems to me that ANZ is rather too bullish, because we know that the household sector is under pressure. We know that the broader economy is weakening. We know that construction jobs are falling. And I'm not sure that a few tax cuts around the edges, which is what it will be sufficient to reverse that anytime soon. So I'm expecting more falls ahead. So now to the markets. So let's look at the indices in detail. Firstly, in Australia, the S&P ASX 100 ended at 5,092 on Friday, up 0.06%. The S&P ASX 200 financials ended 0.07% higher at 5,831. The local VIX, or volatility index, or fear index, was down 0.46% on Friday to 1186. And the ANZ Banking Group was up 0.04% to end at 2603. The Commonwealth Bank was at 7064, which is down 0.38%. National Australia Bank was up 0.64% to 2527. Westpac was down 0.12% to 2592. The Bank of Queensland was down 1.41% to 910. Bendigo and Adelaide Bank was flat at 968. Suncorp was up 0.36% to 1378. And Macquarie was up 0.4% to 199.42. The AMP was up 0.48% to 210, and the lender's mortgage insurer Genworth was up 0.42% to 239. McGrath was down 3.57% to 27 cents and continues to languish, as does Yellow Brick Road, who was up 2.94% but is at now 7 cents. Mortgage Choice was at 99 cents and was up 3.13%. And the Aussie dollar ended 0.32% higher to 70.98. And the gold Aussie cross was down 0.16% to 1,820 on Friday. And Bitcoin Aussie cross was 4,666. And in the US, stocks ended the final trading day of the fourth quarter on a strong note, and the S&P 500 posted its best quarterly gain since 2009, boosted by optimism over the latest round of trade talks between the United States and China. The two sides said they had made progress on trade talks that concluded on Friday in Beijing, and the talks, which are aimed at resolving a nearly 9-month trade dispute between the world's two largest economies, was called candid and constructive by Washington. In fact, the benchmark S&P 500 rose 13.1% in the quarter, and that's the biggest quarterly gain since the third quarter of 2009 and the best first quarter since 1998. But of course, underlying it is a complete switch in Fed policy, because we now know that the Fed is more likely to cut rates ahead rather than lift rates. And across the quarter, the Dow gained 11.2%. That's its biggest quarterly rise since 2013, while the Nasdaq jumped 16.5% to its best quarter since 2012. And all three major indices posted gains of at least 1% each for the week, and registered gains for the month as well. The Dow Jones was up 0.82% to 25,928 on Friday. The S&P 100 was up 0.65% to 1,251. The S&P 500 was up 0.67% to 2,834. The S&P Financials was up 0.83% to 425.83. And Goldman Sachs was up 0.42% to 191.99. The volatility index was down 4.99% to 1371 and is now much more in a region of calm. The Nasdaq was up 0.78% to 7,729 on Friday. Google Alphabet was up 0.39% to 1,176. Amazon was up 0.41% to 1,780. Apple was up 0.65% to 189.95. Facebook was up 0.69% to 166. And Intel was up 1.11% to 53.70. So we can see that prices in the US and in other markets continue into positive territory. And this, of course, is continually being stoked by the prospect of more quantitative easing and lower interest rates, leading to further asset price inflation, at least in the short term. Now, it's also worth noting that the yield curve, which inverted the previous week, and that's where we compare the 3-month bill rate with the 10-year note rate, it actually turned slightly positive on Friday after being inverted for a week. Now, of course, traditionally, such an inversion would signal a recession ahead. And Bloomberg, in an opinion piece, said, imagine two investment choices: 3-month debt that offered a 2.35% annualized yield, or a 10-year obligation with a yield of 2.68%, which is the best option. Now, that might be a tough call, they said, but this might be easier if the 3 months was at 2.42% and the 10-year at 2.39%. So clearly you would go short. And that's precisely what the market has been doing. So denizens of the $15.8 trillion Treasury market can see where it's going, because those were the prevailing levels of the 3-month bills and the 10-year notes at the start of 2019 and now. And that part of the yield curve first inverted a week ago, raising the spectre of a future recession and calling into question when the Federal Reserve will cut short-term interest rates. Investors have been on a bond buying spree ever since, adjusting to the new reality of dovish central banks and potentially slowing global growth. In Europe and Japan, negative yielding debt is the reality once more. Yet, they said, it's largely unnoticed that during the first quarter, there's been a considerable flow of individual investors flocking to shorter dated treasuries, enticed by the highest returns in more than a decade on what effectively amounts to cash. This group, which includes partnerships, personal trusts, estates, non-profit organisations and foundations, purchased $39 billion of bills at auctions in January and February, the most since at least 2009. Gold was 1,296, which was up 0.13% on Friday. Silver was up 0.83% to 1509. Copper was up 2.07% to 293. Crude oil was up 1.52% to 60.2. And Bitcoin was up 2.75% to 4,200. The US dollar index was flat at 97.21. And over in Europe, the British pound US dollar was down 0.06% to 1.3036, despite the uncertain Brexit discussions, which continue to rock Britain. The euro US dollar was down 0.02% to 1.1218. Deutsche Bank was down 0.29% to 7.26. And the Chinese yuan US dollar was up 0.4% to 0.149. The FTSE 100 was up 0.62% to 7,279. And the FTSE Financial Services Index was up 1.36% to 666.54. And the Royal Bank of Scotland was down 0.20% to end at 2.47. So just rounding all that out, we saw the stock markets around the world going higher, supported by the prospect of lower interest rates and quantitative easing and other measures which will inflate asset prices further. But of course, there is still the question as to whether the US will trigger a recession down the track and whether the amount of debt in the system is sustainable. And locally, we still have the same issues here with home prices sliding, the wealth effect going into reverse and households under pressure. And of course, now we're looking for the budget this coming week, which we expect to be quite generous in terms of tax cuts to try and stimulate ahead of the upcoming election. But our own view is it's unlikely to have a significant impact on the results or indeed on household budgets anytime soon. But I do expect further incentives to try and get people to buy into the fading property market. The bottom line is that gravity will continue to exert its force, and there is no doubt in my mind that home prices will continue to slide for some months yet. The credit impulse, as we showed, is still weaker. If you found this post useful and or interesting, please share it, like it, add a comment or question. I read them all. And if you haven't yet subscribed, please do so by ringing that subscribe bell. But if you have subscribed already, thank you. I appreciate your support and participation. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.